Welcome to Let's Grow Podcast and hello ESP Realty. Today we're embarking on a deep dive into the Honolulu real estate market, specifically Q1 2025.
Yeah, and looking ahead, trying to see what the rest of the year might hold for everyone listening.
Exactly. We've got the latest reports, stats, all focused on Oahu. Our mission really just to unpack these trends.
Make it easy to understand, right? Highlight the key takeaways without, drowning people in numbers.
Perfect. Okay, let's get into it. Q1 2025. It painted a really interesting picture for residential real estate here, almost contradictory in ways.
It really did. What jumps out immediately is this kind of tale of two markets.
How so?
Well, you saw single-family home sales dip a bit, down maybe 4% from Q1 last year. That was 569 homes sold.
Okay, a slight dip.
But then condos, they were remarkably stable. Almost exactly the same number sold as Q1 2024, 974 units.
Wow, okay. So resilience in the condo market.
Definitely. It suggests, for a lot of people, maybe those finding single-family homes a bit out of reach, condos are still that key entry point.
And drilling down into just March, that contrast was even sharper.
Yeah, sharper still. Single-family sales were down over 10% compared to March 24.
Over 10%.
But condo sales, they actually rose by over 7%, bucked the trend completely.
So what's our first read on that? What does that divergence tell you or tell our listeners?
Well, I think it really highlights a potential shift, maybe in what buyers are prioritizing or, frankly, what they can afford.
Affordability being key.
Exactly.
Yeah.
The cooling in single-family sales might show they're becoming less accessible for some, which keeps that interest in condos sustained or even growing.
Okay, but here's the twist. Fewer single-family homes sold, yet prices didn't drop.
No, quite the opposite. The median price in March climbed to $11,160,000.
Which is up how much?
Up 5.5% from the year before. And looking at the whole quarter, Q1 year to date, the median was even higher, $1.15 million.
And that's a jump of...
Pretty significant 7.5% from 2024.
Wow, okay, wall condos. They stayed pretty steady.
Yeah. Very steady. Median of $500,000 in March. The Q1 median barely moved, up just 1% year over year to $510,000.
So why are house prices still climbing even when fewer are selling? That seems counterintuitive.
It does, doesn't it? It raises that key question about the underlying forces. Maybe limited supply in certain segments.
Like specific neighborhoods or types of houses?
Could be. Or just persistent high demand at certain price points, even if the total number of buyers shrinks a bit.
And interest rates must play a role.
Absolutely. Fewer sales might mean some buyers are priced out, yeah. But those who can still buy, who can get financing, they're likely still facing competition for the good single-family homes that are available.
Got it. Now, average prices, that adds another layer, especially for houses.
Oh, yeah. The average single-family sale price hit, get this, $1.82 million in March.
Whoa, but I heard there's a huge sale that skewed things.
There was. A massive $65.75 million estate in Kahala. Definitely an outlier.
Okay, so if we take that one out.
Even without it, the average was still around $1.51 million. Still very high.
And condos. Did their average price move much?
It's on a noticeable increase, too, actually, about 6.1% year over year, reaching roughly $614,751.
So what does all this activity at the higher end, average-wise, suggest about the different, maybe, layers of the market?
Well, connecting it back, it suggests different segments are playing by different roles. The high averages for houses, even without that huge sale, point to continued strength at the luxury end.
Limited inventory there, maybe? Or just consistent demand from, wealthier buyers?
Likely both.
Yeah.
And the more moderate average price increase for condos lines up with those stable median prices we saw. Points to a perhaps less volatile segment overall.
Okay, now here's something really significant for buyers and sellers listening. Inventory. The number of homes for sale.
This is a big shift, a really big shift. It's grown considerably.
How much?
By the end of March, 773 single-family homes listed. That's up 33% from last year.
33%. Okay. And condos?
Even more dramatic. A 54% surge, up to 2,302 condo listings.
54%. Wow, so lots more choice. Did new listings also go up?
They did, yeah, new listings rose in Q1. But here's the catch.
Uh-oh.
A larger chunk of those new listings were still sitting unsold at the end of March compared to last year. About 73% of new single-family and 82% of new condo listings.
So inventory is building up. What does that mean for, someone trying to buy or sell right now?
It generally means more leverage for buyers. Simple as that. You get more options, maybe a bit more time to breathe and make a decision, less frenzy.
And for sellers?
More competition.
Yeah.
Definitely. Pricing becomes absolutely critical. You might need to be prepared for your place to sit on the market a bit longer than it might have a year ago.
That unsold percentage really supports that idea, moving towards more balance.
Exactly. Supply and demand starting to level out a bit more.
What about speed? How quickly are things selling? Days on market or DOM?
Okay, this is interesting because it's another contrast. For single-family homes that did sell,
Yeah.
it was actually faster, median of just 15 days in March.
15 days. That's quick.
It's roughly half the time it took last year.
Wow. Okay, but condos?
Opposite story. Median time on market increased to 40 days. That's up from 29 days the year before.
40 days versus 15. That's a big difference. What explains that? Houses flying off the shelf, but condos taking longer?
Well, the fast sales for houses might mean the well-priced, desirable ones are still getting snapped up really quickly. High demand still there for the right product.
Okay.
The longer time for condos. Probably a direct result of that huge inventory jump we just talked about. Buyers have more to look at, so they take their time.
Makes sense. Maybe different urgency levels, too, between house and condo buyers.
Could be that too. Price sensitivity differences, perhaps?
Now, you mentioned inventory increases. Was that happening evenly across Oahu?
Not at all. Very localized. The Edo Plain saw the biggest jump in single-family listings, over 73% increase there.
73.
And Central Oahu more than doubled its listings.
Doubled. Okay. What about condos? Metro Honolulu?
Metro Honolulu actually saw a slight dip in condo contract activity,
Right.
but several areas outside the core. Places like Hawaii Kai, Kailua, Makakilo, Pearl City, Waipahu, they now have double the condo listings compared to last year.
Double again. So what opportunities or challenges do these local shifts create if you're looking in Iwa versus, say, Kailua?
It means the buyer-seller dynamic is different depending on where you look.
Yeah.
That huge jump in Iwa listings might create more opportunities for first-time buyers, maybe military families, could moderate prices there.
Right. More supply.
And the doubled condo listings in those other areas gives buyers there more negotiation power, wider selection, the dip in metro activity, maybe a temporary cooling, or buyers looking outward where there's more available.
Interesting. And we've heard sort of anecdotally that higher-end neighborhoods seem strong, but entry level is more sensitive to rates.
That tracks with the data, yeah. Seems higher price points have more resilience. Entry level feels those interest rate changes more acutely.
So the big picture for residential is balanced.
That's the word being used. Balanced. For buyers. More choice, but maybe need some patience. For sellers, pricing realistically is absolutely key now.
So the essential takeaway for someone navigating this residential market right now.
Increased optionality if you're buying. That's the main thing. But you need to be discerning, take your time, negotiate well.
And if you're selling,
Price it right from the start, based on today's market. It's not 2021 anymore. Properties aren't just flying off the shelves automatically. Strategy matters for both sides now.
okay, great overview of residential. Let's shift gears to commercial real estate. Q1 2025 there had its own distinct trends, starting with the office market. Sounds like it's in transition.
Definitely in transition.
Yeah.
Urban Honolulu office vacancy was, let's say, low teens overall.
Yeah.
Class A in the CBD, the central business district, ticked up slightly to 12.1%.
A slight increase.
Yeah, and there was a small net loss in occupancy in the CBD for the quarter. But, and this is important context,
Okay.
overall vacancy is still way down from the pandemic peak. And late 24, early 25, those were the first back-to-back quarters of positive occupancy growth since COVID hit. So signs of life.
Okay, so maybe a slight pause. But the overall trend is improving from the worst of it. What's driving that potential turnaround then?
A really big factor is office to residential conversions.
Ah, converting old office towers.
Exactly. Major ones like Topo Financial Center, Davies Pacific Center, they're taking a lot of Class A office space offline. Maybe 18% of the downtown inventory.
18%, that's significant.
It really is. And as those conversions happen, the businesses that were there have to relocate.
Filling up other buildings.
Right, helping absorb existing space. Plus, we actually saw office investment pick up. The leasehold interest in Alii Place sold for a good chunk.
So these big conversions are really reshaping the downtown office scene for businesses needing space.
Totally. It's tightening supply in the long run. Short term, yeah, there's still vacancy here and there, but long term, less office space downtown.
And investors are noticing that potential tightening.
Seems like it. That increased investment suggests confidence, probably anticipating that reduced supply down the road.
What about rents? Are landlords able to charge more yet?
Rents have been pretty steady, maybe ticking up slightly. Class A in urban Honolulu, you're looking at maybe $3.30 to $3.80 per square foot per month.
Okay.
As space tightens from conversions, landlords are getting, a little more leverage, but still generally lower than major mainland cities.
And did different areas, different submarkets perform differently? CBD versus Kapiolani or Waikiki?
Yeah, definite variations. The CBD is expected to see vacancy drop quite a bit because of those conversions.
Makes sense.
Kapiolani Corridor saw a small vacancy increase, maybe related to other redevelopment stuff happening there. Waikiki still struggles a bit. Higher vacancy relies heavily on tourism.
Though maybe some adaptive reuse happening there too.
Signs of it, yeah. Taking old office space and finding new uses.
Yeah.
So yeah, different stories depending on the neighborhood and its specific economic drivers.
Okay, let's pivot to retail. Sounds like maybe some stabilization happening there after a tougher period.
Yeah, encouraging signs. After some closures in 2023, Q4 2024 actually saw positive net absorption.
Meaning more space got filled than emptied.
Exactly. That brought overall retail vacancy down to around 5.71%. And the forecast is for it to stay around that mid-5% range through 2025.
And who's taking up the space? What kind of tenants?
Mostly essential retail. Think grocery stores, drugstores, and food and beverage, restaurants, cafes.
What do you think is behind that renewed stability? For businesses? For shoppers here?
Probably a few things. New tenants filling those empty spots, tourism continuing its recovery, bringing foot traffic back, especially in certain areas, and, local consumer spending holding up reasonably well.
And rents. Did retail rents follow suit?
Generally, yeah. Upward trend. Average asking base rent island-wide hit $4.62 per square foot per month end of last year.
Which was up how much?
Nearly 7% year over year.
Okay. Any differences across the island there too?
Oh, yeah. Waikiki still has the highest rents, though they dipped slightly. West Oahu, interestingly, saw a significant rent increase.
Really? West Oahu?
Yeah, while the Honolulu urban core rents were kind of flat.
So different demand levels in different places. Important if you're a retailer thinking about location.
Absolutely. The top-tier shopping centers are doing great. Even the secondary centers are backfilling vacancies. And there's even new retail development planned.
It's just optimism in the sector then?
It does. It gives you a sense of where consumer demand is strongest and maybe where things are shifting.
All right, now, industrial. The data here sounds, well, intense.
Intense is a good word. Exceptionally tight market. Oahu's industrial vacancy fell below 1% again at the end of 2024.
Below 1%.
Yeah, finding large spaces, virtually impossible. Demand is sky high from logistics, construction, military contractors, but supply is just severely limited.
And this isn't new, right? This has been the situation for a while.
For years, yeah. It's a
Empty.
persistent challenge.
Wow. So practically speaking, what does less than 1% vacancy mean for a business that needs warehouse or industrial space here?
It means major headaches. If you want to expand, or if you're a new business trying to set up, your options are incredibly limited. Drives up competition fiercely for anything that does become available.
Landlords must have all the leverage.
Pretty much.
Yeah.
And it can actually hold back economic growth if businesses simply can't find the space they need to operate or grow.
And I'm guessing rents reflect that scarcity.
Oh, absolutely. They've skyrocketed. Average asking base rent hit $1.53 per square foot per month, end of 2024.
Which is up.
Almost 18% in 1 year.
18%.
And land values in the core industrial areas have surged too. There are new projects happening, mostly out in West Oahu.
But not enough to make a big difference.
Projections say even with those completions, vacancy might only edge up slightly, maybe to like 1.6% by the end of this year, 2025.
Still incredibly low.
Yeah.
So why is industrial so uniquely tight here? Limited land.
That's a huge part of it. Just not much developable industrial land on Oahu, combined with that consistently strong demand from multiple sectors.
And the outlook is more of the same. Tightness and rising rents.
Pretty much. Rents are expected to keep climbing. New supply will likely get absorbed quickly. It's just the reality in the market here for industrial.
Okay, lastly for the sectors, let's touch on investment in capital markets. How did that look in Q1?
Interestingly, investment activity actually saw a rebound late last year, carrying into early 2025.
Oh, really? More deals happening?
Yeah, total commercial real estate investment sales increased. And notably, interest from mainland U.S. investors picked up quite a bit.
Mainland money coming in.
Seems so. Colliers is forecasting even more transaction volume for the rest of 2025. And pricing has stayed relatively firm.
What's fueling that renewed investor confidence, do you think?
Probably mix. The ongoing economic recovery, tourism bouncing back, maybe anticipating that tightening supply in office we talked about.
Right.
That mainland interest suggests a broader recognition, maybe, of the resilience and potential here in the Honolulu market,
Uh,
despite challenges.
Okay, that covers the main sectors. Now let's quickly hit some key market drivers influencing all this in 2025. Tourism is always huge here.
Absolutely critical. Visitor arrivals overall are near pre-pandemic levels now, mostly driven by U.S. mainland travel still.
International still lagging. Japan.
Still significantly lower, yeah, especially from Japan. But it is improving. The hope is that as more international tourists return, it'll give another boost, particularly to retail and hotels.
So continued tourism recovery is a key factor for the rest of the year.
Definitely one to watch.
Another big one, the military presence.
Huge stabilizer. Provides consistent housing demand, both rentals and sales. Plus, the basic allowance for housing, the BAH rates, went up for 2025.
Giving military families more purchasing or renting power.
Exactly.
Yeah.
So that consistent demand acts as a real floor for the local housing market.
What about big projects, infrastructure development?
Major things happening. You've got the rail, the skyline, finally operating in phases. That encourages transit-oriented development, TOD, around the stations.
More density near transit.
Right. Then there's the whole new Aloha Stadium Entertainment District, NAZD project getting underway, and Kafako just keeps seeing new condo towers go up.
So lots of construction and long-term development shaping the island.
Yeah, these large-scale projects definitely impact property values and just the overall feel of different areas over time.
And finally, regulatory stuff. Zoning, short-term rentals.
Always evolving. They're enforcing stricter short-term rental rules. Now that 90-day minimum outside resort zones, the idea is maybe that pushes some units back to the long-term rental market.
Potentially increasing supply there.
Potentially. There's been talk, though maybe not immediate action, on an empty homes tax and continued efforts to encourage ADUs, accessory dwelling units, and that TOD upzoning near rail.
All aimed at housing affordability and land use.
Trying to tackle those big complex issues through regulation. How effective it all is remains to be seen, but it's definitely influencing the market.
Okay, so pulling it all together, what's the outlook for the rest of 2025? Let's start with residential.
Expect more of this balanced market. Probably minimal home price appreciation, maybe flat to slightly increasing condo prices.
Sales volume.
Could improve a bit if interest rates come down later in the year. Inventory levels will be really key to watch. But basically, no big boom, no big bust expected. Stability.
Office market outlook.
Guarded optimism, I'd say. Vacancy rates should continue to decline, mainly because of those conversions taking space offline. That could put some gentle upward pressure on rents.
Retail.
Stable, with a positive bias. Vacancy likely holding in that mid-5% range.
Rare.
Rents probably see further modest increases. Pretty steady.
Got industrial. Still tight.
Exceptionally strong. Near full occupancy expected to continue. Rents keep climbing aggressively. New supply will get eaten up fast. Still a landlord's market. Big time.
Okay. So as we wrap up this deep dive for Q1 2025, it's clear we're navigating a market with really distinct stories happening simultaneously.
Absolutely. Residential sees more inventory, more buyer choice, but price is holding relatively firm, especially for houses. Commercial is this mixed bag office recovering slowly, retail stabilizing, industrial fade, incredibly tight.
And all influenced by these big underlying forces. Tourism's comeback, the steady military demand, all that ongoing development, and the shifting regulatory landscape.
Yeah, it's a complex puzzle. The rest of 2025 looks like a period of maybe cautious stability overall, but staying plugged into these drivers is going to be crucial for anyone making decisions here.
Definitely. It leaves you wondering, what specific aspects people are most curious about now? Maybe those neighborhood inventory shifts or the future of downtown office space.
Right. What questions do these trends raise for your situation if you're listening? We encourage you to keep exploring, and perhaps we can dig into some of these specific niches in future discussions.
Sounds like a plan. Thanks for joining us on this deep dive into the Honolulu market.